Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. So today we're going to start off with a slew of new downtrend signals over the past week and a half. A lot of selling pressure, and we're seeing some defensive parts of the market get hit with utilities turning lower and also industrial metals. They're the only commodity group that is moving lower. The dollar is holding up. And then we're going to apply Dow Theory and Elliott Wave to bear markets. So just a heads up on the future of Next Level Charting here at StockCharts. There will be a show this week and next week, but we'll not be doing a show on the 30th of June or in July. And we're going to move to a new format in August. It will not be a weekly show at the same time slot every Thursday. Instead, it's going to be once, maybe twice a month, and the time scheduling will depend on StockCharts TV, but they will let you know in the scheduling when Next Level Charting will be appearing next in August. So I will talk to you this week, next week, and then again in August. So I want to show you the ETF ranking table because we got a slew of Trend Composite signals over the past week, and unsurprisingly, those signals are bearish signals, because we had a seriously strong selling wave that went for 5 days. And it basically started on Tuesday of last week, went Tuesday, Wednesday, Thursday, Friday, and Monday. And I did a rate of change scan for that 5-day period, and 272 of the 274 ETFs that I track in my master list were down. Now, what's interesting about that is that means everything was sold. Stock-related ETFs, commodity-related ETFs, treasury bond ETFs, and currency ETFs, everything. The only two things that were up were corn and the dollar, UUP. And this is the table here where I track 274 ETFs, and it's ranked by the Stoke Close Indicator, which is my relative performance rating. The higher the score, the higher the relative strength. So if you got a lower score, you're not as strong as the one up here. But we can see the leader is energy, DBE, DBC, which is mostly energy as well, commodities, and then the dollar. And if you look down this list of the top ETFs, they're all related to either energy or agricultural commodities. And the only other one is the dollar, of course, and that means the other currencies are going down, like the euro is going down relative to the dollar. So a lot of downtrends out there. And so if I do a sort by name, we get a top-down sort. We get the major index ETFs at the top, and they are all in downtrends. Trend Composite is -5 for all of them. That's how strong the downtrends are. And then we can see these downtrends a number of days. Mid caps, small caps, NASDAQ 100, ETF QQQ, the Dow, micro caps, all in downtrends for over 100 days. So that is over 3 months, basically most of 2022, because these downtrends triggered a lot of them in late January. And then if we look at the recent signals for the Trend Composite, we're going to see that we started seeing selling pressure expand. It got into dividends. The dividend ETF triggered bearish. And then the utilities ETFs triggered bearish. So we're kind of seeing a rotation, not a rotation, but we're seeing the bear market expand, because it started, with these high flyers in the second half of 2021. They got hit. And then you got technology hit in the fourth quarter of 2021. And then you got other things getting hit in January, banks in 2022. And then we got consumer staples getting hit, and now we've got utilities getting hit. So everything is succumbing to the bear market in stocks. And then we're seeing, like I said, utilities and dividends, but we're also seeing industrial metals. The base metals ETF turned bearish as it broke down. So base metals were holding up relatively well, but they're kind of tied to the economy, if you will, demand. And so those are breaking down. So the only uptrends out there are in energy related and agricultural related and the dollar. There's just not a lot of pickings out there as far as the long side of the equation is concerned. So here is the trend composite. It's in the bottom window there, and that's what those signals are based on in the table I just showed you. And there we can see SPY. I'll put on the crosshair. You can see SPY turning bearish there on April 18th, and then it just plunged here. So it's oversold and ready for a bounce, but clearly in a downtrend. And then on the other side, if we look at UUP, we can see that it is in an uptrend. And the trend composite has been bullish since the second half of June as it moves higher. So we got a little pullback here and then a bounce. Fell yesterday, but the overall trend for the dollar is up. And if you're interested in this indicator, you can go to the bottom right-hand corner. There you see the plugins page, the link, and you click on that, and you can click on the Trend Investor Pro Indicator Edge plugin to learn more. And over on the top left, if you open that up, you can see there are the indicators are available, and we've got an ATR trailing stop as well that is helpful in managing open positions. So check that out if you're interested. So we're in a bear market, and no, the definition of a bear market is not when you have a 20% decline. A definition of a bear market is something else. I use a composite breadth model to define the broad market environment. And there we can see in that first indicator window, the composite breadth model has been red bearish since April 11th. And there are the signals. We've got some whipsaws, but that's going to happen. But right now, we're currently on a bearish signal. And since we're on a bearish signal, I wanted to go back and apply some Dow theory and Elliott Wave to the current environment and also look at some past bear markets. So I'm going to work directly off of today's report here at trendinvestorpro.com, and we'll look at where Dow theory and Elliott Wave overlap, and then we'll apply that to a bear market environment and show you how it works. So basically, I started with the tenets of Dow theory, and you can read these in the StockCharts.com chart school as well. But basically, the first tenet is the stock market discounts everything. All known information is already priced in. The second thing, the trend is in force until proven otherwise, and neither the length nor the duration can be forecast. And I believe in that. I don't think you can forecast the length or duration of a trend. Dow theory is not perfect. No indicator is perfect. And there are three primary movements in price: primary, secondary, and short-term fluctuations. And we're going to focus on the primary and secondary movements for the bear market environment that we're in to try and identify which one we're in. So if we look here, we can see you have a primary bear market. It's basically a long-term downtrend that can be interrupted by seemingly significant counter-trend rallies. And this is where Dow theory and Elliott Wave overlap. Elliott Wave says there are 5 waves to an impulse decline or a primary downtrend in Dow theory terms. Waves 1, 3, and 5 are down, and then waves 2 and 4 are counter-trend advances that typically retrace 38 to 61.8%. And Charles Dow was asserting that you retrace between 33 and 66% of the prior decline. So that's where they overlap. Another way they overlap is with the phase 2 of the bear market and wave 3 of an Elliott 5-wave decline, whereas wave 3 in Elliott terms is the biggest, and in Dow theory's terms, phase 2 of a bear market is usually the longest and experiences the biggest decline, because that's when you have the economic ills being affected and hitting the stock market. The news is starting to get bad and companies are feeling it, stocks are feeling it. So let's apply this to the last bear market, which is the global financial crisis. And this bear market lasted from October 2007 until March 2009. And I've labeled the waves. And if we go down to this chart, we can do this in more detail here. But what we can see is there's phase 1, wave 1. So Dow theory phase 1, Elliott Wave wave 1. It's the first decline. And then you have a bounce. That's a counter trend bounce. It's a secondary trend in Dow theory. It's wave 2 in Elliott. and it retraces around 50% of the prior decline. And so you see the overlap there. Elliott uses Fibonacci, 38 to 62%. Dow Theory uses 33 to 66%. In reality, these are not exact levels for either one. They're zones. So once you get around that, 1/3 to 2/3 area, once you get to that 1/3, 2/3 zone, then you watch for a potential reversal on a secondary advance. And we got one with this decline here. Now we had another bounce. It retraced a little less than half. And then there was when things just fell off a cliff in the second half of 2008. And this is clearly the biggest move down of the bear market that went from October to March here. And because it's the biggest move down, in Elliott terms, it'd be wave 3. And in Dow Theory terms, it would be phase 2 of the bear market. That's when the economic ills are hitting the stock market and things are looking bad. And so then you get another bounce, and that's wave 4 in Elliott terms. It's just a secondary bounce, secondary trend, a bounce within a bigger downtrend in Dow Theory terms. And then you have a plunge to new lows. And in Dow Theory terms, this is phase 3. And this is when they're throwing out the baby with the bathwater. Everything is getting hit. There is despair. There's no good news out there. And that's when you get a bear market bottom. But an actual uptrend doesn't take place until you get some sort of a breakout and a sequence of either a higher high or a higher low. And here you can see we broke above that wave 4 high to reverse the downtrend in June 2009. So I went over the 2000 to 2003 bear market as well. That happened after the dot-com bubble burst. But keep in mind, this is subjective chart analysis, which most of it is. But you can see, a big move down, secondary advance that retraces around half, a big move down, secondary advance that retraces a little over half, another big move down, and a secondary advance. And I counted this huge move here as the third wave, and then a bounce, and then a new low there in October. And I also took this information and applied it to the current market environment and made some projections, but I'll leave that for subscribers. Now, keep in mind that any kind of projection or upside target or downside target, take it with a grain of salt, because nobody, and I repeat, nobody can predict the future or forecast where prices are going. We can follow the trend and we can stay with that trend until it is proven otherwise. I think that's the best we can do. So anyhow, I'm going to have a show again next week. And then after that, we're going to be off until August. And it'll be in August when you'll see the next level charting after next week's show. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.